there's going to become a point when keeping rates elevated to the point that they are now is going to cause insurmountable damage that will stay with us through years and not months. The Federal Reserve is threading a needle, and the needle that it is threading is to not crash the economy, but at the same time, contract the economy.
What are the impacts of the Fed's decision to keep rates elevated on not just gold, but the rest of the markets? We're here to examine monetary policy with Gary Wagner, editor of thegoldforecast.com. Welcome back, Gary. Good to see you as always.
Thanks so much for having me. It is great to be back.
I do want to talk about gold first. The price has been on a steady decline over the last month. Quite a pronounced drop over the 25th of September to the 28th, so this week. What happened?
Well, we certainly have seen an accelerated decline. When we look back to the point in which gold had bottomed at $1,913 and then moved up to $1,980 and then began a decline, it appeared at first we could possibly be looking at a correction from that rally. However, the decline this week has challenged that assumption and pretty much broken that assumption, in that today, as well as earlier this week, moves to the downside in gold created technical chart damage, I believe major chart damage, so it is now a different ball game.
We spoke about a month ago, and you were telling me about the technical levels that you would have to see knocked out, rather, on the upside and the downside. So gold hasn't broken out to the upside just yet. I do wonder if, while we're currently at 1865, if below 1880 was a significant floor for you, Gary?
That is a significant area. The key levels that we broke through that were troublesome was 1928. That is the 61.8% fib retracement of just the rally. And the most critical low we broke was $1,913, which is the previous low. That negates any assumption that this recent price decline from 1980 downward is a typical correction. It is now a confirmation that the bearish market sentiment that has been prevalent since March of this year, when it hit its all-time yearly high, is still very much in play. Because of that, we watch traders go into a mode in which they wanted to contain the damage, and technical selling was fierce. In fact, it had been the dollar moving higher that had been the number one motivating factor taking gold lower. This week was different. It was selling-based motivation rather than dollar strength that took the cake in terms of the dominant force moving gold.
Why is it that when equities fall, gold falls with it? I mean, I'm making a generalization. That's not always the case, but it certainly was the case this week. Can we offer an explanation as to why that is?
I can offer a plausible explanation, or what I believe is a logical assumption. Both U.S. equities and gold are reacting to rising yields in U.S. treasuries and dollar strength and elevated interest rates. Excuse me. Business depends on having a medium level, a low level of the cost of borrowing to be able to fund their projects. When you start moving into higher levels, such as 4 or 5 or 6%, then it becomes extremely costly to fund projects, and therefore that will pressure businesses to go lower, unquestionably. The whole idea about bonds in terms of investment dollars, in terms of equities, is one in which a typical investor is looking for maximum return with the greatest amount of safety permitted for that risk-reward ratio. When you're able to get 5% returns on government treasuries, as opposed to taking a risk in US equities in which you can make 5 or 6 or 10%, but you can also lose. Liquidity theory will move a larger percentage of a portfolio into cash or bonds. And that's why we saw weakness in US equities. They are reacting to the high level of yields on US treasuries, as well as gold. The cost of carrying becomes greater, making it more difficult to hold and store gold. Also, gold is not a asset that yields anything, unlike a company or unlike a treasury. So the reason you would get a move in tandem to lower pricing in equities as well as gold has to do with the safety of a fixed income that is providing a better yield than we have seen in years. When is the last time you could get a CD and get 3 or 4 or 5%? It's been quite some time. So when faced with that choice, safety seems to have won out. Lastly, the whole idea of gold being a safe haven asset in times of uncertainty certainly doesn't play out when you can go to bonds for a safe haven, risk-free, relatively risk-free investment.
3.5% or 4% on the CD is beating inflation right now. So not only is it generating a nominal return, it's also, in a sense, inflation hedging for your portfolio, which historically has been one of gold's purposes. So
Right.
Looking ahead then, Gary, key levels you're looking for now before making a decision whether or not it's oversold.
In terms of gold pricing, $1,880 is a key number, and then 1855. But I really believe that as a market technician, I am going to be behind the 8 ball as long as I'm looking at numerically projected levels, as opposed to looking at the potential outcome of current fundamental variables at play. In other words, one of the key things that we just learned last week is that the Fed plans on cutting rates by only a 0.5% rather than a full percent. In other words, the plan according to the June dot plot was 4.25% cuts. Now they're anticipating only 2 cuts. What that means is that if, in fact, they follow through with that projection, that the real level or cost of borrowing funds will be elevated above 5% for the entire remainder of the year. That's going to stifle business growth, which is what their basic philosophy is to do in order to defeat inflation. But it is also wreaking havoc on new home sales and home ownership, because just years ago, you were able to obtain a mortgage at its lowest between about 2.5% to 3%, but in essence, maybe 3.5%, 4%. Tier 1 credit rating individuals are paying 6.5 plus for a mortgage now. And so it prices much of middle class America out of the home that they were looking at. They have less buying power and their cost is greater. And that is going to be a tremendous hardship that we face next year in terms of growing the housing market.
I want to bring up a remark by Jerome Powell from his speech at his last conference earlier in the month. Now, when asked about inflation being a persistent force to deal with, Powell cited several ongoing concerns that could potentially weigh on inflation and keep it elevated. He mentioned the auto worker strike, a possible government shutdown that Goldman Sachs is saying has a 90% chance of happening now. The resumption, I'm talking about next week, by the way, the resumption of student loan repayments, higher energy prices, and higher long-term borrowing costs It's all affecting the trajectory of the economy. It's all affecting inflation. What is your read on inflation? There is a second month in a row now that headline CPI ticked up, and tomorrow, on Friday, we have the core PCE numbers, which is the Fed's preferred measure of inflation. Do you think inflation will stay sticky?
I believe inflation has remained persistent, and it has remained persistent for much longer than the Fed anticipated. First, by believing it was transitory was such a large oversight that it put into motion steps that were incorrect. The most troublesome area right now is oil. I believe that last month, oil increased by 11%. It was the number one item that took inflation and kept it to its elevated rate. That, I believe, will remain troublesome. We might see oil tick down a bit, but it is at a price we haven't seen in quite some time. That is truly a troublesome area. Mortgages being as high as they are is a troublesome area. And food costs, although they haven't been the number one culprit, they have not really declined by any measurable means. So I think that inflation has and will remain elevated for quite some time.
So then I'm guessing you think that rates will also stay elevated for quite some time, meaning that what Powell has telegraphed may actually happen?
I pray not, but I fear so. I believe that there's going to become a point when keeping rates elevated to the point that they are now is going to cause insurmountable damage that will stay with us through years and not months. The Federal Reserve is threading a needle, and the needle that it is threading is to not crash the economy, but at the same time, contract the economy. And at first, we had such high consumer confidence coming after the recession based upon a lot of capital that had been stashed or saved during the pandemic and during the recession. For the most part, individuals, according to articles that I've read, have gone through that reserve. And now they are funding these purchases with the worst possible of debt incurring instruments, credit cards. Student loans, which were on hold, are now coming to a point where payments will begin again. And so that's going to create immense hardship. That, coupled with high rates and employment rates that are still lively, could be the demise of the so-called soft landing or no landing scenario. People continue to go back and forth between whether or not they believe that the steps that the Federal Reserve has taken will lead us into a recession. That was a predominant assumption for quite some time. Recently, because of the strength of the economy, there was the thought that maybe we will have a soft landing or what is called a no landing. It seems less and less likely as the trouble spots continue to fester and goods and services in terms of their pricing remains elevated. And that is troublesome. Where it will lead is only a question over time. Then what I find most interesting this week is the fact that it's almost a certainty that the government will shut down on Friday. They won't pass any legislation to fund the government. The chasm between the two parties are too wide. I am also fairly certain, and this is only an opinion, I'm also fairly certain that when they do come to some sort of an agreement, it will be kind of the finger in the dike, so to speak. In other words, a stopgap measure, as they did last time, that only funds the government for another 2 months because they can't come into an agreement on the major issues at play because the divide is so large. My question is, Why haven't we seen a greater reaction to the government shutting down yet again?
There have been several instances in the past in which the government has shut down. What impact in the past has a shutdown have had? And going forward, what impact on the markets do you think this will have? Suppose it does happen again.
Let's assume that it does happen. The key issue you want to focus upon is how long before they resolve the issue with some sort of legislation, whether it's a solution or just a stop-gap budget bill that is passed. Initially, emergency services are good and Social Security gets paid. And believe it or not, of course, senators and congressmen get paid. So they're not really hurting. The longer it lasts, the more troublesome it becomes. One, because the federal government is such a large employer of US citizens. And so that will filter through the chain. As they don't get paid, they have trouble meeting their financial obligations, putting food on the table and all of that. It all comes down to time. If the government shuts down and within a week to 10 days opens up, I don't see it as being a major issue. In fact, I believe the only reason there hasn't been a huge knee-jerk reaction to the high likelihood that the government will shut down and run out of money is that in the past it was resolved fairly quickly and the fallout was not that great.
I see. So any impact or effect on the Fed's decision on monetary policy from this at all?
The biggest thing in terms of what happens to the Fed is during that period of time, they get no data. So they're not getting updated inflation reports, economic reports, because the BLS, the Labor Department, those in essence are shut down and unable to do their statistical research and reporting.
Well, Gary, let's talk about what you see is going to happen with the economy. We'll close off our discussion here. Jerome Powell has interestingly said that a soft landing is not his baseline expectation. He was asked point blank whether or not this is his baseline, and he said, no, I would not do that. I don't know if there's more than one way to interpret this. Either he thinks there's going to be a recession or he thinks there's going to be no landing, which is what not baseline means if asked if there's going to be a soft landing. What do you think he means by this?
I think it's one of the greatest oxymorons one could look at. In other words, if the Fed's challenge to lower inflation is by contracting the economy, and if the definition of a recession is an economic contraction for 2 consecutive quarters, how can one go without the other? Now, what had happened was the economy was so robust, it kept GDP higher. I believe that we might not have a deep recession, but I'm certain that we will have a recession of some mild magnitude at minimum after all is said and done. Because to contract the economy is the definition of creating a recession. It's how deep do you have to contract it before prices begin to subside?
He does have a difficult job, which is that either way you could argue jobs would be lost in the economy. If he raises rates and causes a recession, people will lose jobs. The unemployment rate will go up. One could argue if he did nothing and inflation stayed as high as it did, one could also argue the Fed caused inflation, but that's a separate issue. But if he had done nothing, higher inflation may have caused some people to consume less and ultimately some sectors to cut jobs as well. That could also be a probability. Do you then, reflecting on the last 2 years, do you think that monetary policy was enacted in such a way that was optimal?
Absolutely not. I think from the get-go, key mistakes were made. If you think about the whole era of 2020, granted, it was a unique time with a unheard of crisis, but there was a point in 2020 when inflation was at 2%, then 3%, then 4%, then 5%, then 6%. We saw it tick up slowly over a period of a year, and by March it had climbed above 8%. At any point 4 months before March, in other words, if you had done it in December or November of the prior year, I don't believe we would have the problems that we have had. So I believe initially the Fed didn't cause inflation, but they exacerbated it by not reacting in a timely manner with small rate hikes to kind of keep it under control. That being said, once they have done that and created the mess that we're in, they were correct in raising rates high enough to have an effect. But then I believe that they were heavy-handed in doing that. We know that there is a lag between when interest rates are raised and we see the net effect in terms of it bringing down consumer demand. Lastly, is the 2% inflation target realistic? I am not the only analyst, and there are many that are much brighter and more brilliant than I am that are holding that same belief, and that is, in this time, would 2.5% or 3% inflationary pressures kill us? Why do we have to go through these dramatic steps to keep inflation at 2%? 9% is unrealistic, 8, 7, 6, but 3% is livable. Personally, I think we're going through an inflation level that's much higher than they reported as anyway. Just go into a supermarket. My point is that, is it correct in sticking adamantly to a 2% target with no wiggle room, with no ability to change the parameters to meet the environment? I would say they're being too one-minded and strict in terms of their resolute nature to get it to 2%. What does that even mean? How different would it be at 2.5%?
That's an excellent way of looking at it. I do believe a few years ago they changed their definition to an average of 2%, but it's still nowhere near the average of 2% when core PCE is 4% and higher.
Right.
So that's an interesting point. It's an interesting question. Is the economy survivable, or can we survive on 3% inflation? That's to be seen. One could argue that further tightening would have more detrimental impacts. Is that what you're arguing? That if they just left things alone right now, things would be relatively okay, but if they kept persisting on fighting this inflation, that would make it worse?
That is precisely my point, because I also believe that by not raising rates to such an elevated level, economic scenarios would really pivot to being more robust, huge growth in GDP, and that in and of itself would be a partial solution to the dilemma that we're in.
Well, Gary, let's close off on your outlook for gold. First, the U.S. dollar, which is another big driver of the gold price. The DXY has been, it's been strong in the second half of the year. What's your expectation going forward?
My expectation is that the dollar will continue to at least not lose much ground or move moderately higher as long as yields on U.S. Treasuries continue to rise. It is a knee-jerk reaction, meaning the dollar rises when yields go up. Yields go up when Fed talk is such that market participants perceive that elevated rates will continue to stay at this level or even move higher. I see the dollar weakening only when there is the honest belief or unrealistic belief that we've seen the most or the last of hikes and we're in a period of pause. Then we can talk about how long it remains elevated, and hopefully they'll come to their senses and actually cut rates by a full percent next year, not 0.5%, because historically speaking, the dot plot is not the most reliable forecaster for Fed action in the future.
And ultimately for gold then, if you're expecting a recession to happen, would that be positive for gold? But we have to consider also what you said about rates being high. That could weigh down on gold. What do these forces mean for the price going forward?
The intricacies of the dynamics in action that work against and with each other, such as higher inflation is a bullish market mover in terms of gold. It creates bullish sentiment. Higher interest rates does the opposite. It creates bearish market sentiment. Which one dominates the thought process, the psychology of market participants is really what will determine where gold goes. At some point, gold will become oversold. The caveat I have to that is we have seen gold maintain exceedingly vibrant strength, remaining above 1900 for the last year plus. And when you look back to, say, mid 2011, after it ran up to its all-time record high, $1,911, it then jumped down to 1,800. And for 3 years, it traded in a range between 1,800 on the high, and I think it was 1,537 on the low, just bouncing back and forth. At that point, it broke below there, and that was the long move down to 1,020 that occurred in February 2015. I will always remember that day because I remember an article coming out how George Soros was buying the ring, so to speak. He was aggressively buying gold when it hit 1,020. And when the smartest man in the room, I might not agree with his political view, but I certainly believe in his acumen to correctly predict where markets are going. So we could see an extended period of time in which gold becomes either range bound or goes lower. At some point it will bottom. My question is, when it does hit those levels, will it be like what we saw in 2013, where it goes between a $300 range? So maybe 1950 to 1750 and bounce back and forth before returning to record highs.
Have Fed pivots in the past been bullish for gold?
Depends what pivot you're talking about. When they were printing money like it was newspaper, absolutely. When they increased their asset sheet into the trillions upon trillions, it was extremely bullish for gold. When they went into quantitative tightening and raising rates and reducing their balance sheet, the opposite happened. So it's not what the pivot will do, it's what is the pivot, and that will mitigate what outcome we should expect to see in gold.
I'm just wondering what the next pivot would mean for gold. Obviously, it's too soon to tell because the Fed's not talking about a pivot. But I'm thinking, going back to your question that you were musing about, when is the bottom? Perhaps the bottom comes when the Fed pivots. I don't know. I'm just speculating.
Well, there's one other variable that could certainly change market perception, and that is tomorrow's PCE. If it comes in at a level that has shown an exceedingly deep reduction in inflationary pressures, that will change the landscape and the thinking of the Federal Reserve, and we could see things happen sooner than later. And the types of things I'm looking at are things that would be of benefit to the American public, North American public, as well as corporate and businesses worldwide.
To simplify things, true or false, you would need to see much lower interest rates across the board before gold rises again. Going back to what you said earlier about the trade-off between bonds when they're high yield and gold, is that true?
That is true, or exceedingly high inflation that no one had calculated. You know, oil going to 150 a barrel, and all of a sudden we're up a couple of points. Either one of those would have that effect.
Right. Very good. Gary, where can we learn more about your work?
Our website, thegoldforecast.com. We do a daily video newsletter. I write an article for Kitco Media each and every day. It comes out at 6 p.m. Eastern Daylight Time. You can always read up on that, and our YouTube channel, The Gold Forecast.
All right. Well, thank you very much, Gary. Appreciate your thoughts, and we'll look forward to speaking with you next time.
Mahalo and aloha. Thanks for having me.
Take care, and don't forget to like and subscribe.